Since ratification of the Foreign Accounts Tax Compliance Act, FATCA, there is greater scrutiny of clients with offshore accounts. As an organization integral in the regulatory process, the Guyana Revenue Authority recently met representatives of the private sector to explain the importance of this endeavor. The holding of cash in secret accounts offshore is the hallmark of tax evaders and money launderers. But with the Foreign Accounts Tax Compliance Act, FATCA, U.S. citizens in particular will find it difficult to conceal financial assets which are not located in the United States. Guyana is supporting the U.S. in the close monitoring of U.S. citizens with offshore accounts by taking into consideration an agreement that would require financial institutions with parent companies abroad to report the assets and identities of U.S. citizens. The Guyana Revenue Authority, which has been designated the competent authority for the U.S. Foreign Accounts Tax Compliance Act, hosted consultations with private sector stakeholders during the week of February 17.
There was a need to tap into taxes that were being either offshore banked and eluded the whole network in the United States. So here was a mechanism devised by way of the hiring of Incentives for Restoration Act 2010 to capture those apparently elusive monies that the Americans thought taxes are due upon. They've devised that strategy, seems to be working, and we are called upon to respond.
Under the Foreign Accounts Tax Compliance Act, foreign financial institutions are those with parent companies abroad, either of a depository or custodial nature, investment entities, or a specified insurance company. Under the Act, they are required to report the assets and identities of U.S. citizens to the U.S. Department of Treasury on an annual basis.
So what does FATCA do? FATCA imposes a 30% withholding tax on payments of U.S. source income made to non-U.S. financial institutions unless they enter into an agreement directly or indirectly with the U.S. Internal Revenue Service and disclose information about their U.S. account holders. So there is a penalty. All right, you have an obligation under this agreement to make the necessary reports.
The United States collaborated with other jurisdictions to establish intergovernmental agreements for financial institutions outside of the U.S. to report account information of U.S. persons to relevant domestic authorities, which would in turn transfer such information to the U.S. Internal Revenue Service. Given the formidable threats posed by cybercrimes, the security of data is a responsibility which the GRA will undertake, especially as the competent authority for the transfer of financial records.
So we are, at the Guyana Revenue Authority, we are on the verge of acquiring a software that would allow us to receive information from the FIs and then, in turn, pass that on to the IRS. And there are specific requirements as to how the information should be reported. And so what the IDES does, it transmits data securely, the sender encrypts the data, and the IDES encrypts the transmission path to protect your transfer. So we have strict rules with regards to the protection of taxpayers' information, and we would have to ensure that that data that we collect from you is totally safeguarded.
The meeting with the private sector is the third in a series of consultations on FATCA.